Well, folks, the Nasdaq is on track for its worst December performance in all-time history. We're clearly going through a remarkable event here in 2022, and it's important to understand how 2023 will play out given the mayhem we have seen this year. Jerome Powell and the Federal Reserve has stirred the pot so much that investors expect 2023 to be an equal or worse year than 2022, despite the fact that interest rate hikes are probably going to be completely paused next year. And yeah, even though inflation has officially peaked, the market now cares about the upcoming recession and its severity on stock earnings and valuations, which is exactly what I want to address in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's try to understand where we have come and where we're going. Obviously, 2022 was one of the worst years for global equity markets in the past 40 to 50 years, given how the bond market has also performed. As we all probably already know, the simple reason for this is that fiscal stimulus was pumped in 2020, and now we're paying the cost of that in the form of high inflation and lower asset values. And as you can see, fiscal impulse flipped in the latter half of 2021 and has been negative for the most of 2022. And this is begging the question as to where is the trajectory for this particular chart going to go in 2023. This right here is the estimate from Goldman Sachs on where we could be headed, which could forecast GDP growth and how the market will eventually end up performing. Given the collapse in the M2 money supply, I do believe that is probably a very likely case. Yes, in 2020 and 2021, we saw a record amount of bond buying, a record amount of stimulus checks handed out, and obviously a significant amount of low interest rate borrowing, which leveraged markets way too much. And as a result, we're witnessing the first M2 money supply decline in the past 60 years, which is obviously something you want to keep in mind if you're deciding about investing or not, because clearly this is a very rare occurrence. And even though right now we know 2023 is not going to be any better, it's still something you want to keep in mind, because we know that at the start of 2021 is when risk assets completely peaked before the overall market started collapsing in 2022. And that was obviously because the CPI report in Feb came out way higher than many people expected. And now that CPI has peaked, there's a very high likelihood that those stocks can start outperforming the overall market. And although yes, not every single high growth, unprofitable equity will outperform, there is a high likelihood, if you're picking the right businesses, that you could see a good return in 23 and 24, as the Fed has already clearly outlined a path about pausing rates and then eventually pivoting at the end of 23. But obviously the mystery amongst the minds of so many investors has been, even though inflation has peaked, why are we still seeing risk assets decline in the short term, with us obviously being on track for the worst month of the Nasdaq here in December? And for me, the simple answer to that question is the market is now focusing on something called earnings growth in 2023. Because basically the market cares about two things: inflation and unemployment. And as unemployment starts to rise, it means corporate earnings are likely coming down, because obviously they're laying off their own workforce. And as you can see, throughout 2022, the S&P 500 corporate earnings projections have fell from around $248 per share to $233.8. Meanwhile, profit margins have also collapsed from around 13.4% all the way to 12.6%. Now, although this is something that could continue into 2023, as an investor, it's important to keep in mind a lot of the market has already priced in the insane reductions we're seeing in corporate balance sheets and obviously in income streams. So as a result, 2023 could see a continuation, but there's a very high likelihood that if we just see a mild recession, that earnings don't have more downside left. Because obviously the Fed has already raised rates throughout 2022, and obviously they have a 6-month lag before they start affecting the economy. And as we all know, March is when the Fed started raising rates, and in the summer is when we saw the most aggressive rate hikes. So if you add 6 months to the summer, we should start seeing the economy actually put in poor earnings for these companies in the fourth quarter and the first quarter of 2023, which means in the second quarter or the third quarter of 2023 is when we should start seeing those earnings reports come out and show us the real damage. Now, trust me, there's no way that I'm predicting the market's going to bottom in the summer of 2023. But based on many projections about what the Fed has done so far, and the fact that the Fed's most important metric, inflation, has already started to come down, this is the chart that we could be following for the next 12 months. Because obviously the Fed has told us they're going to be likely pausing interest rate hikes until they see what inflation's actually gonna do. And if the inflation trend continues down to 6%, 5%, 4%, then the Fed does not need to raise rates anymore, and instead their next focus will be on cutting rates as fast as possible if the economy goes into a severe recession. If the economy stays in a mild recession, then rates are going to stay sideways for a long time, and that is going to be great because it means inflation is likely not going to come back up like it did in the 1970s. And as we all know, higher interest rates do tend to provide good stock market bull runs. And about all this recession talk, it's pretty clear that the recession's here, and it's likely not going to be declared until the latter half of 2023. By the time, it's going to be way too late to invest in any assets because, as we all know, markets tend to bottom before the recession is actually declared. And right now, we're exactly in that phase. And guess what? When the interest rate hikes get paused and we start looking towards cutting rates, the 10-year yield will start going back down. And when the 10-year yield starts going back down, multiples for companies can start expanding, meaning P2S and P2E multiples can start going up for stocks. And as you can clearly see, that has been a big driver for returns in the overall market over the past 10 years. And if you zoom in, you can clearly see here in dark blue how the PE multiple has collapsed since the start of 2021, leading to the declines of so many growth and tech stocks, which is exactly where a lot of the opportunities are brewing today. And to be completely honest, I get excited about the idea of us being in a recession right now. As you can see, building permits and the real estate market are already showing us that recession is upcoming, if not already here. Every single time we've seen permits collapse so aggressively, we've already seen a recession in the next 6 to 12 months. And as we all know, recessions are the best time to either invest in assets or build your business. And it's obviously very rare to find these opportunities consecutively like we're seeing right now over the past 2 years. And it's obviously a common known practice that the stock market always likes to run 6 months ahead of the actual earnings of the company that it's tracking. And right now, companies like Meta, Amazon, and even Tesla are on track for their worst single-year performance in their entire lifetime. That means in the next 6 months, we should start seeing their earnings actually start going down. And if those earnings are not as bad as Wall Street had priced in, then those stocks might actually bottom within that 6-month time frame. So if you think that the inflation story has peaked and that the economy is going to stay on the similar trajectory that it is already on right now, which is obviously downwards, then this could be the timeline we want to follow for our investments if in any way, shape, or form you're trying to time the market. That is obviously the fact that in the summer of 2023, we could start seeing the high quality companies that beat earnings actually bottom. And let's be honest, it's pretty rare for us to see consecutive declines in global equity prices, which is exactly what this chart shows. So as a result, chances are 2023 for equities at least is either going to be a negative 5 to 10% year or actually a positive year like we saw here and here. And with the way the Nasdaq earning yields are comparing to the 10-year treasury, with them sitting at their lowest point compared to the 10-year treasury, there's more appetite to the upside for investors than many people are actually thinking. We saw peaks of this level in 2011 and 2012, and as you can see, overall the trajectory for this number always tends to go up. And right now we're in this historic moment where 10-year yields are going up and Nasdaq earning yields are coming down, both at the same time despite what's been going on with stimulus and quantitative easing. And so as a result, this is something you do want to pay attention to. But obviously, guys, that is just my take on the situation. So let me know your thoughts down in the comment section below.